Okay, great. Good everyone. Great. Welcome to our session tonight. We're speaking about what we need to know when filing our taxes. I hope you've had a wonderful day. I hope you continue to experience the favor of God in all that you do. As a church, it's our privilege to welcome you. We believe that in the faithfulness of God, and we believe that in all things, God wants for us to be heavenly minded, but also for us to be very wise about how we go about our daily activities. And one of the things that we do at our church is try to empower you with different tools so that you would live your everyday life more effectively. The mission statement of our church is changing our world with the word. And the vision statement rather is changing our world with the word. The mission statement is Word Life Christian Fellowship exists to equip people with the transformative word of God and the tools to empower them to embrace and fulfill their divinely ordained purpose. So that is the purpose for which we exist. Just by way, just so you know, as I mentioned, we're a church. We meet via the same link that you came into the meeting with. We meet on Sundays at 10 a.m. This coming Sunday will be a special service because, as we know, it's the Easter season, and we celebrate the resurrection of our Lord Jesus Christ this coming Sunday. So it'll be a special service. The meeting ID is the same as for this meeting. And then on Tuesdays, we have Bible study. There's a separate meeting ID for that as well. Tomorrow, we have Good Friday service. As you may know, tomorrow is Good Friday, the day when we commemorate the crucifixion of our Lord Jesus Christ. And then, so we'll have a brief service from 7 till 8 p.m. tomorrow. So if you can, do join us, and I pray that you'll be blessed. Again, on Sunday, we have our Resurrection Day service at 10 a.m., the same meeting ID as I mentioned before. And we have a special speaker that day is Apostle Jonathan McKay from Beyond Church here in Fort Lauderdale. Okay, so welcome to each of you, and I pray that you've had a wonderful day and that you look forward to an engaging time here this evening. A special request of you, as we go about this session tonight, this is very important for us. As a church, we'd like to be applicable and relevant in all that we do. So throughout the session tonight, we'll be speaking about taxes. But what we're doing now, this new phase of our ministry, is that we want to help you to live your everyday life more successfully. So we want to have sessions that are engaging, that are impactful, and that you can implement in your everyday life. If you would do this for me, do this for us. If you would put in the chat of the different sessions, the different areas that you see on here, which of these would you most like to learn, to have sessions about? Every first Thursday of the month, we have these sessions, we have these seminars. As I say that, I also say next month, in the month of May, because of a scheduling conflict, we will not meet the first Thursday, which is May 4th. Instead, we will meet Thursday, May 11th. But except for that exception, each first Thursday of the month, we will meet, okay? So if you would just put in the chat the areas in which you believe you could use some teaching, some encouragement, and some things that I believe, so we can be relevant and applicable to the different things that you may have in your everyday life, right? So if you would put in the chat, and I will revisit this slide later on in our session, right? So personal finances and budgeting, I guess tonight would fall under personal finance and budgeting, and we'll talk business taxes to a certain degree. So do let us know. Again, we want to be applicable and relevant to you in your everyday life, right? And if you do this for us as well, if you would share with others in your network, in your family, because it's all about empowering individuals to help them to live their everyday life successfully. Okay, so tonight we're looking at what we need to know when filing our taxes. As you may know, tax deadline is around the corner. It is Tuesday, April 18th. Officially, it's been April 15th forever and a day, but I personally cannot remember the last time that it was actually on April 15th. This particular year, April 15th falls on a Saturday, but the deadline this time around is on Tuesday, April 18th. Okay, why are you here? What do you seek to gain from this session? I have prepared quite a bit of information. I believe the last time we had such a session, there was a lot of information, a ton of information. I have condensed it to a certain extent, but I would like for this session to revolve around you and what your particular interests may be. And so I'm going to ask you whether it be, well, ideally, if you would speak and let us know just now what you seek to gain from this session. I know the last time around, there was a lot of talk about business and business taxes, and we will certainly touch on that to a certain extent tonight. Part of this will necessarily be repetitive because I don't believe you learn all you need to learn about taxes in one session. But what do you seek to gain from the session tonight? With that said, I'm going to ask you if you would unmute yourself and share with us what you may seek to gain from the session tonight. Anyone? What do you seek to gain from the session tonight? If you don't say it out loud, I'm going to assume that I can just proceed with just a regular with my slide as I have it, right? But I don't want for this to be another session where it's just by the book. I want for it to be applicable and relevant to you, right?
I have something to say.
Yes, please.
Okay, so just like the last time, I'm in here and I am working. I think that for me, especially in my industry as an esthetician, I noticed that a big issue is people getting their clients to pay in cash because they don't really know how to maximize savings when where taxes are concerned. So I was interested in that, to learn about how to save, different things that young business owners can implement. Even when, you know, there's a lot of people who have businesses, but they don't do business full time, how they can kind of apply some of the tax code to work in their favor. Yeah.
Okay. So apply tax code to work in their favor. Okay. So small business. Okay. So Christina, thank you for sharing that. And I will, when we get to that part, I'm going to give you the floor again so we can be as specific as possible for your particular question. Thank you, Christina. Anyone else? What do you see to gain from the session tonight? And by the way, if you're in an area where you cannot speak, then that's fine. Just you could type it in the chat if you would, because again, I would like for it to be as applicable and relevant to you as possible. Anyone else? Okay, feel free to use the chat. I'm gonna proceed. Before we go further, let me just share with you a bit of background about myself. My name is Roderick Walters. Oh yeah, I didn't put my name on the slide. My name is Roderick Walters. Okay, yeah, there we go. Roderick Walters. I am a certified public accountant. Believe it or not, I hope I'm not dating myself, but this is my 30th year in the accounting profession. I've been in the accounting profession since 1993. I graduated from the University of Texas at Austin in May of '93, and and over the years I've practiced in tax preparation and tax planning and preparation for individuals and small to medium-sized businesses. All right. So that's a bit about myself. Part of this, as I believe I mentioned, will maybe somewhat repetitive. If you were here at the last session, I hope that well, a little bit of the feedback I got from the last time is that it was very detailed. Somebody told me that their head hurt after the session. My intent is not to make your head hurt. So I'm going to try to be on the surface to a certain degree. And if you want me to drill in and dive in, I'm more than happy to do so. But I want to be on the surface. Okay. Before we go any further, I want to say this. A general rule of thumb when it comes to your taxes, from 1 year to the next, your tax return will look essentially the same unless there's something fundamentally different. Your tax return will look the same unless there's something fundamentally different. Today, I had a conversation with a client. Actually, yesterday, my assistant had a conversation with a client, and the client was complaining about, I don't get it. I don't understand. How come, this year I made less money. I made half as much money. How come it is that I owe, $150, where last year I made more money and I got a refund of $2,500? Again, the rule of thumb, from 1 year to the next, your return is going to be the same pretty much unless there's something fundamentally different. And so I had him come into my office today, and I broke down to him, return by return, side by side, what was going on. And when he saw it, he was just like, oh my goodness, I did not know. I did not even realize that this job from which I made $15,000 this past year, I had zero federal withholding. And the job from which I made $70,000 last year, actually $67,000 last year, I had $10,000 withholding. From 1 year to the next, it's going to be pretty much the same unless there's something fundamentally different, right? So that said, let's continue. Let us proceed. And by the way, I can talk. In many ways, I get paid to talk. My intent is not to have tonight be me talking the entire time. If you do have questions, if you would use the raise hand feature, or if you would type something in the chat, just so I know that I could be aware that you may have a question. This is being recorded, by the way. It'll be on our church's YouTube channel shortly thereafter. We're also broadcasting live on Facebook just now. So you can, if you're in the session, great, wonderful, but you can catch it at a later point as well. Or if something we may touch on might be somewhat overwhelming to you, then please know that we're more than happy to communicate. We're happy to help you along in your journey. Okay. And again, part of this is somewhat repetitive, but I just want to highlight a couple of things. Income is money received, especially on a regular basis, through work or investments. That's income. Forms of taxable income: salaries and wages. You work at a company, you get a W-2 normally. Interest income, dividends, etc. Unemployment compensation, retirement income, social security income, rental income. A form of income that is not reflected on here, but I want to touch on tonight because I believe during the last session, there were several questions regarding that and the potential impact of it. And I think it's very important. And I'm going to gloss over a bit of this. And if I'm moving too fast, please let me know. My intent tonight is not to overwhelm you, but to just give you enough that, to pique your interest. Later on, I will give you our church's telephone number, and always, always, always feel free to call. You are a priority to us. Your success in life, not just your spiritual life, your success in all that you do is of a priority to us. And so please, and do connect with us, and we'd love to help you on your journey as best as we can. Okay, actually, this one is here. Self-employment income for a sole proprietor. This is so essential, so important. We'll touch on this in a bit. Actually, let me not go there right now. Hold on. Income from ownership interest in an S corporation or a partnership. Okay, so sole proprietor. You have a Schedule C on your personal tax return. You're a sole proprietor, or you can be a partner in an S corporation or a partnership. a multi-member LLC, etc. They're forms of income. Okay. Tax brackets. I'm just going to touch on this briefly. Tax brackets. If let's say if you make $50,000 a year and you pay whatever amount you pay in taxes, it's not that you multiply your $50,000 times, okay. So if you're single, you see right here on the screen, if you're single, pardon me. If you're single, you make $50,000. It's not that $50,000 times 22%. No, on the first $10,000, you will pay 10%, 10,275. Then the next from 10,276 to 41,775, you pay 12% and so on. So it's tax brackets. It's not one size fits all. It's different tax brackets that how your taxes are done. Okay. Actually, let me pause for a second. Actually, no, I'm going to proceed and then I'll pause to take any questions. Tax deductions versus tax credits. A tax deduction is a reduction of taxable income, thus resulting in a reduction of tax liability, a reduction of taxable income. Whereas a tax credit is an amount of money that can be offset against a tax liability. Generally speaking, it is better for you to get a tax credit because that's a dollar for dollar reduction of your taxes, as opposed to a tax deduction, which just reduces your taxable base. So in some cases, you may get a $10,000 tax deduction or a $2,000 tax credit. Generally speaking, the $2,000 tax credit is better for you than a $10,000 tax deduction. A tax deduction just reduces your taxable income, whereas tax credit reduces your income tax dollar for dollar. Okay. I don't want to dive too deep. Any questions at this point? Any questions, anyone? Okay. All right. Let me proceed then. Actually, we're also live on Facebook, so I'm gonna just keep my eye on Facebook as well. And if anyone there has questions in questions as well, I'll take there. Okay, if you're on Facebook, feel free to ask any questions of me. Okay. Tax credits, non-refundable credits versus refundable credits. A refundable credit is a credit that can be used to generate a refund larger than the amount of tax paid throughout the year. Non-refundable credit, the credit that can only be used to reduce income taxes owed. It cannot be used to increase a refund. It cannot be used to increase a refund or to create a tax refund when there would not otherwise have been one. Okay, you know what? I think here's what I'm going to do, because I believe the last time around we're a little bit more interactive, and I don't want to just proceed not necessarily knowing if you're getting it, and I don't want to get overly detailed. I'm a very detail-oriented person. I can get very detailed as much as I'd like. But what I'm going to do is I'm going to fast forward a little bit, right? We spoke about the different types of taxes and tax deductions and so on. What I want to do now is this. I have prepared a sample tax return, and what I'll do is, as we go through the sample tax return, I'm going to highlight a few things to us, right? So it can be very practical, so we understand it. Again, please. I'm happy to talk, but I want to know that it makes a connection with you and it is applicable and relevant to you. That's the most important thing. As much as I'll talk all day, but that's not the point. The point is that I want it to be applicable and relevant to you. Okay, so what I'm going to do, I'm going to share my screen and share a tax return with you. Okay. This tax return it's the same one that we had the last time, but I've made a few tweaks to it. All right. This tax return is for a couple. They are the best, Mr. Best Client and Mrs. Best Ever Client. Right? Mr. Best Client, Mrs. Best Ever Client. And what you have is they are married, filing jointly. Don't worry, I'm not sharing anyone's confidential information via the internet. This is just a made-up social security number, made-up client name, right? And same thing for their children. If you look down here, you will see the Prince client and Princess client. Prince is you see this box checked here. That means that that Prince is the couple gets the child tax credit. The couple gets the child tax credit for Prince. That tells me that Prince is under age 17 because you get the child tax credit only up to age 16. Once you turn 17 and older, the parents no longer get the child tax credit. Princess, what this tells me that Princess is 17 or older because you see this box checked here for Prince, child tax credit. That means he's younger, and then Princess is the child tax credit. Okay, there's that. Now, what we have here is income. We spoke about income, W-2 income, W-2 earnings. So the couple made jointly on the W-2 made $104,654 this past year. We go further on the tax return. We'll see that they had $225 of interest income separate of taxable interest income over here, $225. Over here, what we see is that they had $500 of tax exempt interest, right? So altogether, they had interest of $725. 500 of it was non-taxable and 225 of it was taxable. Dividends as investment income, etc. I could go very deep into this, but I won't unless you ask me to, because I don't want to overwhelm. Okay, the next thing is they have $1,200 in dividends. They received an IRA distribution, an IRA individual retirement account distribution. Then they received $3,000 in pension, right? So this tells me that more likely than not, this couple, or at least one of the persons in the couple, is older, right? Older. Why? Because they are collecting IRA distribution, pension distribution, and the next one here is Social Security. If you have any family member who is on Social Security, just know this: if Social Security is their only income, and by the way, welcome everyone. I see the different names coming in at different points, and I can get myself in trouble by welcoming individuals, so I will not welcome you by name, but welcome everyone, and I hope this is an engaging session for you. Again, I've said this before, but if you just come in, if you have a question as we go along, please feel free to stop me. Feel free to either turn your camera on and raise your hand, or use the raise hand feature, or type something in the chat, just so I can know, because this session is not for me to tell you all I know. That's not the point. This session is to be engaging and to be impactful to you, because if you have not already done your taxes, or if you have a tax preparer, whatever the case, if your taxes are not yet complete, then they are officially due April 18th. I'm going to talk about extensions tonight briefly, right? We're going to talk extensions. tonight. Okay. All right. Okay, sorry. If you have if you're on Social Security, just know this: if Social Security is your only income, if that's your only income, or your primary form of income, then more likely than not, you will pay zero of your you'll pay zero taxes on your Social Security. Zero. If it's your only income, you'll pay zero. You actually don't even need to file a tax return if that's your only income. Zero, right? You pay zero in taxes. So you could have a couple that they're retired. One person makes 24,000 in Social Security, the other makes 12,000. So together they have $36,000 in Social Security. They don't even need to file a tax return at all, right? The next thing is that if you have, the more income that you have, the more of your Social Security that can be taxed, right? The more income that you have, more of your Social Security that can be taxed. But your Social Security cannot be taxed more than 85% of its total, right? Okay. What I'm doing is we had the session last time, and I'm just trying to give different pointers and give you some insight into things that you may have not heard, what that wasn't said the last time, or I believe would be helpful to you. Okay, so this couple, Social Security. So chances are you may have a older, one of them is older, right? Or one of them is older. I'll leave it at that. 6,300 in Social Security. Of that amount, because the couple has so much more other income, then 85%. And let me do the math and confirm that, because with that amount of W-2 earnings, then more likely than not, this 6,300 that we see here is times 0.85. Yes, correct. So this 5355 is 85% of the 6,300. Over here is the total Social Security. Over here is the taxable portion of the Social Security. Okay, that's a mouthful. At this point, I'm going to fast forward to something that we had a ton of questions on the last time around. Okay, again, I have prepared a particular PowerPoint, and I want to move along with it. But because there were like questions upon questions as we did this last time, I'm going to fast forward to this part of the presentation. And if I need to come back to some of this other stuff, I'm happy to do so. But last time around, we spoke a bit, about personal taxes. But I know Sister Julia had some questions, and then Sonia had some questions about that as well. And so what I want to do is touch right now on the business aspect of things. A brief word about business taxes, all right? Christina mentioned earlier, she's an esthetician, she has her own business. Some of us have our own business on a full-time basis, right? Some of us have our own business on a full-time basis. Others of us have a business on the side. Most persons who go out on their own, they don't just quit their job one day and go out on their own, right? What they do is they have a regular job, and then they start doing their work on the side. And so you have two jobs going, simultaneously. And then for some persons, there comes the inevitable point where your side work is beginning to overtake your everyday work and begin to be more time consuming. And more importantly, it begins to pay you a lot more than what you initially had when it was just some side work. And so what happens to many persons is that they start doing their business on the side, and then because it becomes successful, they get to a point where they quit their day job and go full-time into their business. But not having a good knowledge thorough knowledge about the structure of such a side business, it can be detrimental from a tax standpoint. Not detrimental to say that you get in trouble with the IRS, but detrimental in that if you do not know the tax law and the way that the tax code functions, you can easily pay out your nose, pay a ton more in taxes than you would even realize. And sometimes I've had a ton of clients over the years who come to me. They started their side work. They have a you know, however, it could be a law office. It could be they are you know, they have a, you know, I don't know, car wash. They, whatever the case, whatever the different areas, start your own business. But if this business is started without the right knowledge as to how that business should be structured, then it can cost you and cost you dearly if you're not careful. All right. So this is not to alarm anyone or anything, but what happens is that you have choices when you start a business. And a lot of the times people go with the default because the default is to do a Schedule C on your personal tax return, right? Because you don't need to register with the state of Florida or any state to start a business. If you get side work, you just put that side work on your Schedule C, profit or loss from business, and that's it. But when it goes on your Schedule C, the ramifications of that are huge, potentially huge. So I'm just gonna give you a bit of insight on that now. And I hope that this is helpful to you, because this what I'm about to say to you, I have seen this save taxpayers tens of thousands of dollars, hundreds of thousands of dollars, what I'm about to share with you. And by the way, this session is free tonight. Don't take it for granted, because a lot of what is being shared tonight, I could easily do a seminar, or I could do a thing over a period of weeks where I charge $5,000. I wouldn't do it through the church for sure, but I could easily share the information I'm sharing with you now and charge $5,000. And people sign up left, right, and center, because if I don't mind paying somebody $5,000 if it's going to save me $100,000, right? So I'm not trying to toot my horn or anything. I'm just trying to say that this information, please do not gloss over it or just take it for granted, because it's essential, it's important. And particularly, you know, as a Christian, I believe that we're all gifted. In Proverbs 18, verse 16, it says, a man's gift makes room for him and brings him before great men. So I believe that each of you is skilled, each of you is gifted. And if you're operating in your gifting and you're doing well from a financial standpoint, this is essential. This is like oxygen for your business, because if you do not know some of these things, you can easily have $1 million business and overpaying by tens of thousands of dollars in taxes every year without having to do so. Okay, so with that said, let me share this with you. The major forms of business entities: a sole proprietorship. What's a sole proprietorship? A sole proprietorship is if you are, let's say, I mean, you could be a teenager making money mowing lawns. You don't have to register the business with any entity. You have a sole proprietorship, sole proprietor, right? You could open a store. You could be an Uber driver. You have a sole proprietorship. You could be, you don't have to do anything to have a sole proprietorship. All you need to do is be yourself, and you have a business, sole proprietorship. That's the easiest form of business to start. Just start the business. In Florida, you have what's called a fictitious name, right? Fictitious, it almost sounds illegal or scandalous, but it's not. Fictitious simply means, fiction and nonfiction, right? Fiction means the well, sorry, fictitious name. Let me just say it. Fictitious name means that you're doing business under a name other than your personal name, right? So I'm Roderick Walters. So if I wanted to have Roderick's mobile car detailing, then I can register with the state of Florida a company with a fictitious name owned by Roderick Walters. So Roderick Walters is the owner of Roderick's mobile car detailing. So there we go. Or Roderick could just do that business and not register with anybody. And that's great. It's easiest form of business to start. If you've done side work, whatever the case, then chances are you are sole proprietor. If you do work and get a 1099, you're a sole proprietor, right? No entity registered, sole proprietor. Great, wonderful, no big deal. The downside to sole proprietorship is that it is just an extension of you, the individual. So you're susceptible to liability issues. So if there's something that goes wrong, you're not protected by an entity. Now you're sole proprietor. So your individual assets are potentially at risk if you have a sole proprietorship. The next thing is LLC, a limited liability company. Limited liability means that your liability is limited, meaning that the entity, actually the next few forms of businesses that we look at will have the component of limited liability as well, right? But LLC is a fairly easy form of business and to start. A single member LLC is what's, let me not go into that. You have a single member LLC, multi-member LLC. They're treated differently for tax purposes. I will just leave it at that because I don't want to overwhelm and go into certain amount of detail, all right? Single member LLC, multi-member LLC, I'll leave it at that. But your potential exposure when you own an LLC is only the assets of the entity. If you do business as an LLC, they can only come after the assets of the entity. They cannot touch your house, they cannot touch your personal belongings because they're limited to the assets of the entity. C corporation, if you start a corporation, if you start a for-profit, you could start a nonprofit. That's a different issue altogether. If you start a for-profit corporation, the entity is automatically a C corporation. Automatically a C corporation. I'm going to come to S corporation in a moment. C corporation and S corporation. A C corporation, again, once you form a corporation, it's a C. A C corporation, it's an entity that also has limited liability. But one issue is that you have double taxation. Why? Because the corporation, it pays taxes on its net profit, right? Because of the Tax Cuts and Jobs Act of 2017 that went into effect January 1st of 2018, all C corporations in the United States, they have one flat tax rate of 21%. One flat tax rate of 21%. S corporation, on the other hand, it's different. Actually, time out, let me back up. C corporation, one flat tax rate of 21%. It's double taxation because the entity has 21% tax rate. The owners, if they get paid dividends, you also pay taxes on dividends. So as an owner, you get, the company pays taxes and the owner pays taxes on the dividends that they may get from the company. Next, S corporation. S corporation is a corporation that is considered a tax conduit. A tax conduit. If you are sitting at a computer like I am right now, what you have is there's power in the electricity that flows through the wall, et cetera, et cetera. And there's a cord that I plug into an outlet, and the outlet is plugged into the computer. The cord itself has no power. It simply is a conduit through which the power flows from the outlet into my computer, but the core has no power. In a similar way, an S corporation is a tax conduit. The corporation itself does not pay income taxes, but rather the income from the entity flows through, and that's why they call it a flow-through entity. Income flows through the S corporation to the individual owner, and the owner or owners pay taxes on their personal income tax return through the S as a result of the S corporation. This is not on the screen, but the form on the S corporation's tax return that connects the corporation to the owner's return, it's called a Form K1. So if you hear people talking about my K1, it's Form K1 that connects the income from the owners, from the company to the owner's personal tax return. And the last form of entity that we'll look at right now is a partnership. A partnership is, these are less popular. The first four, I think, are the most common forms of business. A partnership return is a bit different. You see this a lot with real estate investments and so on. Okay, I've said a mouthful, and for me, some of this stuff it's just natural to me. I don't have to think about it. It's just part of me, part of who I am. But I recognize that it's not your daily life, right? So it may be a bit much information for you. Does anyone have any questions at this point? Any questions?
I could see Sister Vinell holding her head. Christian, in a corporation, like at the end of the year,
yes,
you pay everybody, all your bills are paid, and then you have like, say, $5,000 in the bank.
yes.
Is it becomes the owner's, it becomes income to the owner? Yeah. And you have to pay taxes on it?
Yes. Great question. Great question. Before I answer that, Julia, I see your question in the chat. Christina, I also see your question, and I will address those in a moment. Okay. All right. So, Melbourne, your question leads to another question before it leads to an answer. All right. So, ask a question for me again. Time out. Hold on. I'm going to share my screen and ask a question for me with everything on the screen, and you'll have you'll see the direction in which I go. Okay, go ahead for me, bro.
Okay, you have a corporation. Doesn't matter if it's SC or LLC. But at the end of the year, you pay all your bills. I mean, employees and utility, whatever. But then I end up with like $5,000 in the bank. Does that becomes the owner's money and it is taxable?
Okay. So you say you have a corporation. The answer to your question, it depends on if it's a C or if it's an S, right? Most small businesses are organized or are taxed either as S corporations or, well, most small businesses are not C corporations, right? You can be a C, you can easily be, I mean, you start out as a C anyway, but okay. money coming out of the company, it depends. It could come out of the company as an expense, or it can let's say it's a S corporation. I'm going to come the S corporation route first, then I'll go to the C corp.
It's an S corporation.
S corporation. Okay, good. The S corporation, you have monies that are in the entity.
Mhm.
If there's expense, paying rent, paying whatever, then that reduces the income. So let's say you have $100,000 and you've paid $70,000 in expenses, right? Legitimate business expenses.
Mhm.
But you, the owner, take out $25,000, right? I'm gonna come again. $100,000 revenue or sales revenue, etc. $70,000 in expenses, right? So we're left with $30,000 now, and then the owner takes out $25,000 from the company, right? The S corporation, the owner taking out $25,000, that is not an expense, but rather that is a distribution of the owners of the earnings of the company, a distribution. In that case, with that S corporation, the owner is taxed on $30,000 because there's $70,000 in expenses, and 25,000 was just a distribution. But the overall income, so he could have left that money in there, taken out 20, taken out 30, regardless, he's taxed on $30,000.
Okay, what if, okay, that money stayed there. I mean, he already get paid. Everything is get paid.
Mhm.
Does that at the end of the year, that money just stayed there in the company? Is it taxable?
Yes,
Yes.
it's income.
But it's remember, no,
It's income.
I understand. But the owner, I'm just trying to wrap my head around this. The owner get paid, everything paid. He have a surplus left in the bank. It becomes the owner's money and it is taxable. And you said yes.
It's income.
Wow.
All right. And
Come after expenses.
Wow.
all right. And then Mel, one of the things I've found throughout my career is explaining distributions. It's
Right.
it makes perfect sense once it makes perfect sense. Until it makes perfect sense, it makes no sense whatsoever. Okay.
That's what I'm
All right. Okay. So let's say if we make it a time out, Mel, let me say this to you as well. Same scenario, $100,000 revenue, 70,000 in expenses, right? The owner, 7,000 expenses, not including the owner's salary. The owner can take $25,000 in salary, which would be an expense to the company. It's the same money going to the owner, but this time it comes out as a salary from which he draws a W-2. That is a $25,000 expense to the company. So what remains is $5,000. Technically, with that salary, there's payroll taxes added to it, etc. The company matches the payroll tax, but whatever is left is, let's say, a little bit less than $5,000. That amount is taxable earnings to the owner. All right. If it's same scenario, C corporation, what we said before, after expenses, we have $30,000 left. The C corporation would pay 21% of $30,000 as their income tax expense. All right. All right. I love questions. Does it make sense? Is it clear as mud?
Yeah, it makes sense, but you know, I am just thinking, okay, so that money there. But if when the year turns around, you have to use back that money, put it into the business, you still pay taxes on it and still have to put it back into the business.
No, that's fine. Listen, if that money remains there, it's fine. You've paid taxes on it already. It's earnings of the company. That's why owner's distribution it's a great thing. I mean, it's there. You take it out or leave it in there. It doesn't matter because it's income to you. Period. Let it stay there. Let it grow. You know, but it's
I understand because we don't pay sales taxes on it already. Nobody get the money. The money is there.
correct.
So it's wow. Good to know.
Yeah. Okay, good. All right. So Christina says clear as mud. I like that. Yeah, clear as mud. Awesome. Good stuff. All right. Okay. So Julia had the question: is that DBA doing business as doing the sole proprietorship under under a name other than your own? Correct. Okay. Great. Great question. And you put that on the checks and the bank account, right? Okay. So I used the term fictitious name earlier, right? Okay, help me with this because I messed up earlier. Fictitious. Okay, so okay, a nonfiction book means it's real, right? Nonfiction means it's real. Okay, so fiction. Okay, good. Fiction. Okay, good. Thank you. Fictitious name. Fiction, right? Fiction means it's not real. So a fictitious name is just like Roderick is doing business. I think I had Roderick Mobile Car Detailing earlier, right? Roderick Mobile Car Detailing is a fictitious name, meaning it's not Roderick, but Roderick is doing business under under a different name. A fictitious name, they call that they call it DBA. DBA, doing business as, right? Doing business as DBA. Now, so you can, by the way, you can have a fictitious name. A human being can have a fictitious name, right? So Precious can have a fictitious name doing, Precious Jewels. Yeah, Precious Jewels. She has a jewel shop, Precious Jewel. Precious has a fictitious name, right? But for tax purposes, you can have well, let me back up. The state recognizes a corporation in a sense, or these entities like they're a different, like they're their own person, right? So if you have a company called, let's say, Julia's life insurance, usually life insurance business, right? It's called Julia's life insurance business, right? But Julia may want, okay. Oh, I like that. Julia's jewelry. I like that. Okay, good. Okay, let's go with that. Julia's jewelry. Oh, that's a tongue twister. Julia's jewelry. Julia's Jewelry Incorporated. Julia's Jewelry Incorporated. Let's say Julia's Jewelry Incorporated, and she wants to do business because the smart watches are the latest phase. So she wants to have a section of her company that only specializes in smart watches, right? So she can have, so the company can own a DBA name. So it can be Julia's Julia's smart watches, and that name is not owned by Julia. The name is owned by Julia's Jewelry Incorporated. So it would be Julia's Jewelry, DBA, doing business as Julia's Smart Watches, right? So DBA, DBA, doing business as. Okay. Christina asked the question, which do you think is the most beneficial for startups? I believe that the most beneficial, and hear this well, please make a note of this. The most beneficial for startups, I believe, is an LLC. The most beneficial for a startup is an LLC. And I will elaborate on that in a moment. But please, 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 you are highly intelligent, highly successful people. The world is your oyster. Please don't don't cut it off and say, okay, perfect, startup, LLC, I'm gonna run with it. Because if you run with it with your LLC and you're successful, highly successful, it's gonna cost you dearly if that's all you do is just run with it and start up as an LLC. Okay? I say an LLC because it's fairly easy to start. A single member LLC, there's like a single member meaning only one owner. There are no annual, at least in the state of Florida, there's no annual income tax filing requirement for the LLC as an entity. A single member LLC is called a disregarded entity for tax purposes. A disregarded entity. That means that the entity itself does not file a separate income tax return, but that income is done on a Schedule C on your personal tax return. Schedule C on your personal tax return. It's a disregarded entity for tax purposes, a single member LLC. Be careful though, because when you become successful, we'll see in a moment why showing a lot of income on your single member LLC tax return is going to cost you dearly if you're not careful. Okay. Okay. Christina asked the question: is there anything that a startup business can do to benefit from the tax code monetarily, or should we be focused on just growing revenue? Okay, great question. Oh my, oof. You need a PhD in question asking, right? Great question. Yes, there's a lot that can be done. And by the way, listen, I am happy. It's the thrill of my life to have these discussions, right? The only way I've gotten, to where I've gotten in my journey, is because of the love of God and his plan for my life. But then secondly, the mentors and the persons who have guided me along in my journey. When I was in college, I was the president of NABA, which was the National Association of Black Accountants. And at different points in my professional life, I've also been a member of NABA. The slogan of NABA is lifting as we climb, right? As we're climbing, people are lifting us up. We have an obligation to lift others up as well, right? So please, I'm saying this to us live here. I'm also saying it to anyone who may watch the recording, anyone who may be on Facebook. Please connect. I'm happy to share. I won't tell you what my CPA billable hours are when I do CPA work. I won't tell that to you. But what I'm saying to you, your success is of everything, it's essential to God. It's important to God. And he's given me a role to play in his kingdom. And so I'll avail myself. I put on the calendar, at different points throughout each week. Typical, especially these days, I have appointments with persons having nothing to do with work at the office, having to do with what we're talking about right here. I have an appointment 5 o'clock tomorrow afternoon. I had an appointment earlier this week. I'm not trying to toot my horn or anything, but what I'm saying to you is that I'm not just talking while I'm talking. I'm saying to you that one purpose for my life is to help to empower you in these areas. So Christina, yes, there's a ton of ways that small businesses can look to benefit from the tax code monetarily. The first one, though, I believe, is having an understanding of the way to structure your business. Very simple. Start out with an LLC. But be prepared for that LLC to elect to be taxed as an S corporation. If you're successful, be prepared for your LLC to be taxed as an S corporation. That is a winning strategy, a winning formula. I've seen that particular scenario a good few thousand in my 30-year career. I've seen that scenario play itself out a few thousand times. And it's a beautiful thing when I see it happen. I had this one client who had literally $1.1 million, $1.1 million on a Schedule C. Oh my goodness. And I was able to prove to him, and I did the math right in front of him. He overpaid that particular year by approximately $45,000. By approximately $45,000. One of the first things that I did, get that same entity that he had and make an election for it to be taxed as an S corporation. Now we do taxes and we laugh. We applaud. How beautiful it is. How beautiful it is. If you don't know, you don't know. And once you do know, knowledge is power. Knowledge is power. The word of God tells us, my people perish for lack of knowledge, So I'm just sharing with you information tonight. Okay, this is important. So I want to get to it. All right. I'm going to give you a warning, and then I'll show you an example of what I'm speaking of. Okay. The warning is this, and this may sound bad, but you'll see where I'm going with it. Word to the wise, beware of the self-employment tax. Beware of the self-employment tax, because if you do not know the self-employment tax and how it functions, very often you'll be like the person who comes into the office and they are like, oh my goodness, is there anything that we can do? Is there anything we can do? Can we come up with some more expenses, etc., because this is just too much. This is just too much. Beware of the self-employment tax. What is the self-employment tax? Okay. The self-employment tax is this. Oh, give me a second here. Self-employment tax is this. This is a definition straight from the IRS website. Self-employment tax, a tax consisting of Social Security and Medicare taxes, primarily for individuals who work for themselves. That's beautiful. That's wonderful. We all want Social Security. We all want Medicare. We do, right? We want to contribute to Social Security because the self-employed person, they pay income tax, but they don't have really an obligation to pay self-employment tax, well, which is Social Security and Medicare. So that's a very good thing. But here's the thing. It's calculated on Schedule SE on your personal tax return. So if you have a sole proprietorship, you pay self-employment tax on Schedule SE. It's calculated as 15.3% of 92.35% of the net income on Schedule C. 15.3% of 92.35% on Schedule C. Okay, it's a bit too true, but let me just share this with you. All right, hold on. Okay, I'm going to give me a second here. Okay, I'm going to fast on this example, this sample tax return that I have a Schedule C, and I'm going to show you something why we have to be careful with the Schedule C's in our lives. All right. Okay. So to continue with our example, Mr. Best Client, he's an Uber driver. How cool is that? Yeah, he's an Uber driver. So see Schedule C, profit or loss from business. See, sole proprietorship. Schedule C, profit or loss from business, sole proprietorship. What happens is he's an Uber driver. He's material participating in the business, etc. Okay. He does a lot of driving for Uber, for Lyft, and he makes a lot of money. And this is great. Again, you don't have to form an entity or do anything. You just do your side business. At the end of the year, Uber sends you their statement. If you do work for some people, well, if you make more than $600 or more paid to you, the company that pays it to you, $600 or more in a calendar year, they're supposed to issue to you a 1099. Many don't, but they should. And if they do not, they can get in trouble with the IRS. But that aside, $45,000. Okay, $45,000. Uber. He's done a lot of driving, right? So with the driving that he does, give me a second here. Where's his page now? Okay, with the driving that he does, that this year he drove. Well, it's probably more than this, but keep it simple. He drove 12,000 miles around town, right? 12,000 miles around town. And with the 12,000 miles, with the standard mileage deduction per mile, he got $7,300 in expenses for vehicle expenses. He had some supplies, taxes and licenses, etc. Then on page 2, he uses telephone for a certain extent, postage and delivery, bank service charges, $190. Okay. So after all his expenses, what remains is the $34,908. $34,908. He has a sole proprietorship. He gets his 1099, the Schedule C. At this point, as the expression goes, his goose is cooked, right? Because it's not necessarily a bad thing. At this point, he has no choice, zero choice, but to pay 92.35 times 15.3% of this figure, and that's your self-employment tax. That's your self-employment tax. Okay, so the self-employment tax, let me find that Schedule SE. Schedule SE, give me a second here. There's complications on this return that I won't bother you with, but self-employment tax, you will see, here we are, 34,908, 92.35, 32,238, and then down to 15.3% of 32.328 gives us $4,933, right? So this is his self-employment tax. This portion is for Social Security. This portion is for Medicare. So you actually, as a self-employed person, you're actually paying into Social Security and Medicare. But unlike when you had a job and you get paid and the boss gives you the paycheck. I'm going to stop my screen share for a second. I'll share it back in a moment. When you have a job, oops. Sorry, I turned off my camera. When you have a job, your boss issues you a paycheck, right? So let's say you make $1,000, but what you get in your hand is $750. Why? Because the boss withholds Social Security, 6.2%, withholds Medicare, 1.45%, and then federal tax withholding, and then what you get is $713. The company then matches not the federal, but your Social Security and Medicare. So that's an expense to the company, right? As a self-employed person, guess what? You are the employee as well as the employer. So that is why you pay double. If you look at the math, 15.3% is really Social Security, which is 6.2%, plus Medicare, 1.45%. Together, they're 7.65%. You multiply that times 2, 15.3%. So there you go. That's your Social Security and Medicare. That's your self-employment tax. Okay. It's great, it's wonderful. But here is what, actually, time a second. Any questions at this point? Any questions? I know there got to be questions. I know there have to be questions. Come on now. Or some people say, come on, somebody. Come on, somebody. No questions? Clear as mud? All right. Yeah, that's clear. I just said clear as mud. And Christia said clear. Christia typed in clear as mud. All right. Are we good? Following slowly. Okay. All right. So here's where I'm going. Listen, I'm happy to talk, but I don't want to overwhelm you with information. I think last time around I heard my head hurts. My head hurts because it was so much information. I don't want to overwhelm anybody tonight. Okay. All right. So don't blame me if I go deeper, because ain't nobody say nothing. So I'm over to keep on talking. Okay. All right. So here's what happens. On their tax return, here's how it works. And there's different parts of the tax return that I could go into, but I won't because it's overwhelming and I don't expect you to get a PhD in tax preparation. But I want to show you something, right? In this case, their taxable income was $114,000. If you see here, the income that they made there, $34,908. Their taxable income is $114,000. Included in the $114,000 is the $34,908. Now we're calculating income tax. We're calculating income tax. Nothing else right now but income tax. Your income tax is $114,000. Sorry, your taxable income is $114,000. I'm going to fast forward to a form on this is not on your tax return. You will not see this on your tax return, but it's a supplemental schedule in my software that shows just how the tax on $114,000, the income tax on $114,000 is calculated. They're married filing jointly. Okay, married filing jointly. Here's how $114,000 is calculated. Here's how you calculate tax for a couple married filing jointly. Taxable income $114,000. You have what you hear. This is one of my favorite forms to show to clients. The tax reconciliation sheet. What happens is this. The 100. Well, okay. I'm gonna recant something. The taxable income is $114,000, but part of it is taxed as long-term capital gains. Long-term capital gains. So 9,200 of it is taxed at 15%. All right. I'm not talking about that 15% right now. I'm not talking about this 9,200 right now, right? That's taxed at 15% because that's capital gains tax rate. I'm looking at the remaining 105. Okay, the remaining 105. The first $20,000 is 10%. Here's the tax. Here's the income. Here's the tax. First $20,000 tax as 10%. Then the next bracket is the next $63,000 is taxed at 12%. Then the next $21,897 are taxed at 22%. All right. And so we'll put that all together. And what we have is their income tax is $15,812. That's their income tax. there's a bit going on this return. I'll just say last time around, we looked at credits, refundable credits, non-refundable credits. Tonight, we will not speak about that. That last session is on our YouTube channel. If you can go look for it. If you put your contact information, if you send your contact information to Dinley Walters, you don't have to give it to everybody. But if you send a private chat to Dinley Walters, your contact information, we can email or text the link for that session with you. We can email or text it to you. Okay, just send your private contact information to Dinley Walters, or you could send it to me, Roderick Walters, as well. But you need to put your private information in the chat, right? in the public chat. We'll just send it confidentially, or at the end, we can send it. We can. I'll give you the church's contact information. You can just reach out to us. We'll get it to you. Anyway, it's on our Facebook page and YouTube channel. We'll talk about refundable and non-refundable credits. Okay, so back to where we were now, right? So the point is that the income tax was $15,812. That's your income tax. You had some tax credits which reduced the $15,812 down to $11,212, right? But after you've paid the income tax, here comes the self-employment tax to bump you up $4,933. So you're now on the hook for, so in the $16,000, that's your tax liability. What happens is with the $16,000, part of that is income tax. Technically, only $11,000. Technically, only $11,212 is income tax. The rest is self-employment tax, but it's all paid for on your income tax return. And if you don't pay it, then the IRS will issue interest and penalties and make your life not cool. All right. So that's the thing I wanted to mention. Okay, so here's what happens now. He had $45,000. The couple had he had $45,000 working for Uber. I mean, being an Uber driver. But what about when you start a company and the company is successful, wildly successful? What if after expenses you have $100,000? $100,000. What you have is $100,000. I mean, I could do the math real quickly, right? On $100,000, let's say I have gross revenue of 150,000, 50,000 in expenses. So the self-employment tax on $100,000 is just under $15,000, right? So it can go higher and higher and higher, right? What you can do, and this part is involved, call me and I'll talk to you further about it. But what you could do, remember I say if your company is growing and wildly successful, you can elect for your company to be taxed as an S corporation. Elect for your LLC to be taxed as an S corporation. Why? Because the same scenario, $150,000 in revenue, $50,000 in expenses, you're left with $100,000. Now, what happens is, in this Schedule C scenario, single member LLC, disregarded entity, Schedule C scenario, you have no choice. Your self-employment tax is what it is, $14,129. It is. There's no getting around it, right? The only thing you could try to do is to increase your expenses so your base gets reduced. But whatever the case, you're going to be doing some math and you have no choice. If you have the same entity, same scenario, taxed as an S corporation, what you could do is you have $100,000. You can say, I'm going to take a salary of $20,000. And on $20,000, what you do is you calculate this S corporation, you calculate, it's no longer self-employment tax, it's now payroll tax, but the math works out to be the same. In the same scenario, you have $20,000. Now you have sorry, mine just went back. $20,000. Now you have 15.3% of that, which is for payroll tax. So $3,060. $3,060. And so with this basic example that I just gave to you, by electing the same income, by electing to have your entity treated as an S corporation for tax purposes, that same scenario, you just save yourself $11,069. $11,069. You did that just by electing to have the same entity taxed as an S corporation. Does that make sense? There's a method to the madness, right? In our world, there's a method to the madness. Anyone? I know a lot of that stuff has gone over some of our heads. I know it has. I don't claim to be a know-it-all, if you will, but there's a lot of this stuff that I share. It's kind of matter of fact to me. It's just part of what I've done for, almost 3 decades, actually for 3 decades. But something like this is essential. So you can elect to have if you have an LLC, you can elect to have it taxed as an S corporation for tax purposes. All right. You don't have to, but it's just a word to the wise. Okay. Any questions? Please don't speak at the same time. Okay. All right.
I have a question.
Okay, great. Hi, Abigail.
Hi, I came in a little late, so I missed a few key things in the beginning. Do you mind just naming a few that you feel is like key for me to know?
Okay, sure. And thanks for asking. And just so you know, this is recorded and it'll be on our YouTube channel afterwards. And if you drop your contact information directly to Denley Walters or to Roderick Walters, or when you see church contact information as well, we could send the entire recording to you after this. But so while we're here now, I just want to highlight a couple of things we had touched on earlier. Abigail, when you came in, did we speak about? Had we already spoken about the difference between the different forms of entities?
I don't believe so.
Okay, all right. Yeah, let me just give a brief synopsis of all of this. And I won't go through everything. I just give a Cliff Notes version, if you will, right? The different forms of income and how they are reflected in the tax return, right? And then what we said is that when you make money, your income is taxed at different rates depending on your filing status. You could be single, married filing jointly, married filing separately, head of household. So if you make $50,000, the example I used earlier, if you're single, make $50,000, you would see that right here, you fall in this tax bracket. That does not mean that 22% of your income at $50,000, yeah, you pay tax on 22%, but rather you pay on the first 10,275, 10%, then the next up to 41,775, 12%, and then the rest up, 22%. So it's tax brackets. and understanding the way that all works. Tax credits and tax deductions, it's better to get a tax credit. Better to get a tax credit than a tax deduction, generally speaking, right? We no longer have in school, we no longer have the tuition and fees deduction, but there was like a tuition and fees deduction or the American Opportunity Credit, right? The tuition and fees deduction, let's say if you're in college, would you prefer to get a $12,000, you pay $12,000 for school, you prefer to get $12,000 tax deduction or a $2,500 American Opportunity Education Credit? Generally speaking, it's better for you to get a tax credit because the amount might be lower, but it impacts your taxes greater. A tax deduction just reduces your taxable income. Tax credit reduces your actual income tax dollar for dollar. I didn't really talk about refundable and non-refundable credits tonight, but there are, some credits called refundable and non-refundable credits. A refundable credit, actually I talked a little bit. A refundable credit, it can give you, actually, let me just share this with you. Oh, just a second. Refundable credit, tax credit can be used to give you a tax refund larger than the amount of tax paid throughout the year, all right? Non-refundable credit can only reduce your taxable income. Like the child tax credit can reduce your taxable income, but there is a separate credit called the additional child tax credit, which is it's a refundable credit. I don't want to get into the weeds. It's a little bit involved. And again, I'll give you the church contact information. I'm happy to discuss any of this with any of you at any point. Well, not necessarily at any point. I'm busy, but we can put it on the calendar, certainly, because you're a priority to God, and so you're definitely a priority to us, okay? Actually, I'm glad you asked that because I'm doing a little bit of a review through this process anyway. Tonight, we focused more on the business aspect of things. And so what I said is that the major forms of business are these. Business form of business are sole proprietorship, which is you can just start a business. You bake. A friend of mine, when she was in college, she just started baking. She fell in love with baking. So she just started baking. And so she registered her baking company. She just started baking and she just had it just start baking. And then from her just starting to bake, she registered a single member LLC, right? And then now she has she's now elected to have that LLC taxed as an S corporation as the income has increased. Sole proprietorship is the easiest form of business to start. LLC, limited liability company. Limited liability meaning that the exposure, the potential exposure is limited to the assets of the company. Your house, your car, your personal assets are not touched when you are doing business in a limited liability company. If you have a sole proprietorship, there's not limited liability, so your personal assets are potentially exposed. C corporation, if you have a corporation, it's automatically a C corporation. I don't think I mentioned this earlier. You can, when I said you can elect to have it taxed as an S corporation, there's the form that you use to elect to have it taxed as an S corporation is a form 2553. Form 2553 is where you use to elect to have your C corporation taxed as an S corporation. Your LLC can be, you can elect to have your LLC taxed as a S corporation as well. That LLC, again, through form 2553 can be done. S corporation and partnership are, as well as LLC, are considered tax conduits. tax conduits. They don't pay income tax. A C corporation pays a flat tax of 21% across the board, but an S corporation partnership, they are tax conduits. They do not pay taxes, income taxes anyway, but rather they pay the owners pay taxes on their personal return, but the entities themselves don't pay taxes. They're called flow-through entities or pass-through entities. They are tax conduits, right? This stuff is so essential. And listen, the spirit of entrepreneurship is alive and well. Most businesses in America are small businesses, small to medium-sized businesses. Small businesses are the lifeblood of the American economy. God bless the W-2 earners among us, but there's something for the entrepreneurial spirit that some of us have that it's like a fire shut up in our bones. It's just a natural part of us. We like independence. We like to chart our own course, and it's good to know all these things as you go about it. Having rental property I just thought of that. Having rental property is something different altogether. We could at a different point talk about rental property and what that might entail, et cetera, et cetera. One thing that I did not touch on, which I think it's important to touch on, and I had an experience with a client regarding this just this week, and I have them with clients all the time. Most of the times, and please, my people perish for lack of knowledge. My people perish for lack of knowledge. Most of the times, when people do their taxes themselves or get their taxes done, most of the time, here's what they do. Their eyes go first to write this down here. In this case, these people they owe $1,649, and they have an underpayment penalty of $4. Most of the time, we want to know that we have a refund of whatever amount. Refund of $5,000, $3,000, $7,000. That's what we want to know. We don't care how we got there. We just want to know that we got a refund, right? I even have a discussion with this one client today regarding this, and a separate client yesterday regarding this, to say, stop looking at the bottom line, because this bottom line, you can control this more than you might realize, right? Stop looking at what happens at the end of the process. It's like getting to the finish line and only worry about, I came in second place or whatever place. No, focus on the entire race. Each year, there's something that you could do throughout the year to position yourself for exactly where you want to be when your taxes have been prepared. Rather than focus there, have this in mind. This line that says total tax, focus on minimizing your total tax. You can contribute to an IRA. You can contribute to a SEP. You can contribute to, you can do, charitable deductions. You could do mortgage interest, depending on your filing status. You could, there are a ton of things. You can have a business and have some write-offs in the business, and you could reduce your taxable income. You could do that throughout the year. As an employee, you have total control over this figure. How much is withheld on your W-2? You can opt to have very little or almost none withheld, or you can opt to have as much withheld as you want to throughout the year. This is entirely under your control. And so what I like to do with clients is to empower them. Ask, what would you like? Because some people, if they get a tax return, if they do a tax return and they don't have a refund, they're liable to have a heart attack. Oh my God, I had this older client years ago. I mean, he passed away 2 years ago. But I remember every time, he was like in his mid to late 70s. Every time I did his taxes, if he owes, he just like, oh my God, you're gonna kill me. I owe the IRS You know, I always say, listen, calm down. There's much we can do. Let's position ourselves. But there's some people who they want to owe the IRS at the end of the year because they felt like I'm not going to give them tax-free money, a tax-free loan that they can do whatever they want throughout the year. I want to have, I don't want to do that, but instead, let me do what I want with the money. And at the end of the year, I'll pay them what I owe them. So wherever you may fall on this, it doesn't matter. I can help position you, or you can help position yourself, or your tax preparer can help position you to where you need to be or where you desire to be. Be proactive and planning. You have total control over this figure right here. If you want a $5,000 refund, you can position it where you get a $5,000 refund, and you have no choice but to get a $5,000 refund. Yeah, it's just not matter of fact like a crystal ball and oh wow, great, I got a $1,000 refund. No, you position yourself to where you want to be. I had a discussion with a client this afternoon. Last year, she and her husband got a $8,200 refund, $8,200 refund. This year, for the first time in the 5 years I've been doing their taxes, this year, I had to break the news to her that they owe $1,400. How do you do that? It's by design. And I told them what they did wrong. Talk to your tax preparer throughout the year and be empowered with knowledge. Man, people perish for that lack of knowledge. So don't focus only down here. This is after the race is over. At this point, there's very little you can do regarding this. Think throughout the year about this figure, your total tax, and think about what you could do with this. All right. Woo! And in church, we say, hallelujah. All right. If you cannot tell, I have a little bit of fun doing this because it's just a natural. Okay, so pay estimated. Oh, so Julia said pay estimated taxes throughout the year, right? Great question. Great question. You can, it depends. All right. For the self-employed person, absolutely, yes. Pay estimated taxes throughout the year. And there's things that you could look at, you know, to see, you know, how do you do that, right? The IRS, what the IRS does is they say, if you are self-employed, they want to, you can have, see in this case here with this client, you might show you that they had underpayment penalties of $4. You see right here, underpayment penalty of $4. What happens is that from 1 year to the next, the IRS, and just keep this in mind, look at your own tax return when you've done it. Look at your own tax return. 1 year to the next, through either tax withholding or estimated payments, right? Through estimated payments or tax withholding, if you pay 110% of your previous year's tax liability, you are considered to be penalty proof. Penalty proof, right? So 110% of this figure, if you pay it throughout the year, then you're penalty proof. So these people were not penalty proof, meaning that they didn't incur underpayment penalties. So your estimated payments, yes, those are due, you know, quarterly for self-employed. Not necessarily, well, for self-employed, I'll just leave it at that. Okay, the due dates for those estimated payments are, it's kind of weird. It's April 15th, June 15th, September 15th, and January 15th for estimated payments throughout the year. All right. So there you have it. There you have it. Let me just look at the chat. Oh gosh. Ooh, okay. We often look for that refund. Okay, but there's scam. Okay, yes, there's scam preparers who do taxes every year, get people in trouble every year. Yep, absolutely. I'm a CPA. I'm a I've been a Texas CPA since 1994. And I've been a Florida CPA. I've been in Florida for however many years. I have a license and I have responsibilities. There's things that I do at church and so on. But I have a license. I have a responsibility. Each year I have to take 40 hours continuing education. So I'm on my A game during tax season and otherwise. And this is not about me and my life and my work. I'm just saying to you that yes, there are scam tax preparers. Whoever, I'm not looking for clients when I do these sessions, by the way. I'm not. I have my hands full. The goal is to empower you with knowledge to do your own taxes or to go to your own tax preparer, and that tax preparer can help you. If you have any questions throughout this process, I'm happy to answer your questions as we go along. Okay. This is pretty much the presentation I had for you tonight. And again, I pray that this has been informative for you. Any questions, any additional questions? Did we touch anything we did not touch on that you want to touch on as we're wrapping up?
No questions, just wanted to say thank you.
Oh, you're very welcome. It's my privilege. It's my honor. It's the one of the great main purposes for which I live. All right. All right. So let's see here. Anything? Okay. You're quite welcome, Abigail. It's my privilege. And let me just give you a little bit more info. Oh, I did say this earlier, and Abigail asked a question. I want to mention this to us. This is part of the reason that we exist as a church, and so I would like for you to do this for us. Okay. Special request. I said this earlier, but some of you came in afterwards, so I'm going to ask you. The first Thursday of each month, we meet in the session. As I mentioned earlier, next month, month of May, because of a scheduling issue, we will not meet the first Thursday, but rather the second Thursday, May 11th. But generally the first Thursday of each month. Tonight, this will fall under personal finances and budgeting, and to a certain extent, business and entrepreneurship. If you have a question, you'd like to see in these areas, either put it in the chat or call the church office or contact us by whatever means. Let us know what area you would like to see. Our goal is to empower you with knowledge so that you can apply that knowledge and gain wisdom in the process. All right. That last one you see on here, programs for youth and young adults. Do not underestimate what's going to go on there, and I will leave it at that. All right. We're a church, but we have an obligation to educate and empower you and inform you with these matters. All right. So please, you can take a screenshot of this, send to us areas you'd like to see information in. Okay. All right. So I just want to just going to share with us this again. If you came in afterwards, we are a church, Word Life Christian Fellowship. And actually, one second, let me do this as we're wrapping up. And just a brief thing about us. Our vision statement is change our world with the word. Change our world with the word. We exist to equip people with the transformative word of God and the tools to empower them to embrace and fulfill their divine ordained purpose. And this is one area through which we do so. We meet on Sunday mornings at 10 a.m. Eastern time. The meeting ID is the same as this session tonight, right? And Tuesdays we have Bible study. Tomorrow, Good Friday, happy Good Friday. We have a brief service using the same link, 7 to 8 p.m. Sunday, morning worship, celebrating the resurrection of our Lord Jesus Christ. And we have a special guest speaker, Apostle Jonathan McKay from Beyond Church in Fort Lauderdale, Florida. All right. So I pray that tonight has been a blessing to you. And I thank you for joining us. And was one more thing. Let me just share with you this. Just a second. Okay. Let's share this with you. Just keep calm and see you at the next session. All right. The next session is May 11th, not May 4th, but Thursday, May 11th. All right. So that's the next session. And here's our church contact information. Thank you for joining us. 954-775-0436. And there's the information, info@wordlifecf, as in Christian Fellowship.org. Okay. So that's a bit about us and about this session. And again, I pray that it's been a blessing to you. And let us pray as we close tonight's session. Father, we thank you for your faithfulness. Thank you, God, for being with us. Thank you for just educating us through this very practical area, God. In the next several days, many of us will be completing our taxes. I pray that this session has been informative to each one, and I pray, Father, that in all things you be glorified through our lives. Bless each one that participated tonight and that was present tonight. And I pray, God, that they will take some nugget of wisdom away from this session. Help them to utilize the church contact information to help them to know that we're here, to help them along their journey through all that is done. Through all that is done through these sessions and in different aspects of their lives. We give you glory, honor, and praise. We thank you for your goodness. Thank you for your faithfulness. Hear our prayers, we look to you with grateful hearts and say thanks in the name of Jesus. Amen. Okay, everyone, thank you again for joining us. Do contact us if you have any questions, and it's been an absolute privilege. And you're very welcome again, Abigail. My best to you and to everyone else. Again, I don't want to get in trouble by calling names. I've seen some names I've never seen before. Seen some faces I've never seen before. I don't want to get in trouble, but welcome each and every one. Oh gosh, and actually, before we go, I just want to highlight some of our those among us, please. I'm going to spotlight a few folks, Brother Melbourne and Sister Jennifer. All right, they are, and this is for our leadership folks. Brother Melbourne, Sister Jennifer, thank you for all that you do for our church. Sister, this is Sister Precious Herring. All right, Sister Precious, she's our prayer ministry leader. By the way, Sister Jennifer is the one whose face you would see on a typical Sunday morning. She's the first face you see. She's the one who greets everyone. Sister Precious is just a precious one. Sister Vinell Vincent, all right, and she's a precious woman of God as well. Thank you, Sister Vinell. And then last but not least, I want to highlight Sister Denley Walters, right? She happens to be my better, some would say better half. Yes, she's my better half. She's clearly the better one. My better half. All right. And that's it. So we're a family of believers, and we just thank God for each one. Thank you for everyone for being here. And I pray you have a blessed rest of the night. Don't want to call it any. Actually, I'm gonna go out on a limb and say Christina Walters is my daughter. It's not just another person. She's my daughter, Christina Walters. There she is, Christina Walters. She's my. Okay, there we go. Hey, baby girl. All right, all right, and that's it. All right. Thank you each one for joining us. God bless you richly, and enjoy the rest of your night. And hope to see you tomorrow evening. Same link for Bible study, and so for Good Friday service, 7 p.m. tomorrow, and then Sunday morning we meet for worship. Okay. Have a blessed rest of your night. God bless you. All right.